Hi, everyone. John Boardman here, founder and CEO of Ballast, and really appreciate you all joining us this evening. We're here tonight, actually live, to discuss a recent white paper we just published called Stock Market Bubbles, Are You Prepared? Actually joined by all of our advocates in the office over here. We have Cameron Hamilton, Director of Financial Planning, Brian Burton, Director of Portfolio Strategy, Andy Reynolds, Chief Operating Officer and Financial Advocate, and Frank Yoswick, who is our Director of Estate Planning and Tax and Financial Advocate. So really, the reason we wanted to have this discussion this evening, we get a lot of questions about, are we in a bubble? What is a bubble? Should we be prepared for things to fall as markets have done so well? And we just think it's really important for everyone to hear our thoughts from time to time. At the end of the day, what we're really talking about here is behavioral finance. As an individual, you obviously have control over how you dictate your investments and how you direct your assets. And then we also have the aggregate of the markets and just people in general and all the money that's sloshing around out there and how it's behaving. And so we wanted to talk a little bit tonight about how we manage that and in consideration of how the entire market is functioning at any given time. So I would like to go ahead and hand it over to Brian. Got to give him a lot of credit. He spearheaded this project from the beginning. So Brian, hand it to you.
Yeah, thanks a lot. Thanks for everyone for tuning in tonight. We're glad to have you tuned in. Just to add on to John's point, we really started talking about this topic back 21 months ago. So right at the onset of the pandemic, really, we had all just been sent home. We were working, from our guest bedrooms, literally on makeshift card tables, trying to, do the best we could, in the new circumstances that we found ourselves in. And markets at that time, were experiencing a pretty sharp sell-off. I'm talking mid-March here. Markets were down, I think, about 30% already off the top. We had just been at recent highs, all-time highs in the market in February. So there had been a lot of talk about, are we in a bubble territory in equity markets, and what can we do about that? And so we were having a very long conversation that will be with me, probably for the rest of my career. It was a pivotal time. Screens were flashing red, and we were trying to remain as unemotional as possible so that we could make the best decisions for our clients. And it really drove us to further research, the topic of asset bubbles. I mean, we had been through, the last two big bubbles bursting, but we really wanted to learn more about, investor psychology and behavior during these periods, and just how we could improve, our services to our clients, by learning more on the topic. So we got into, writing this white paper, and just wanted to deliver this to you all, tonight. Just some ideas and thoughts we have. So I'll jump right into, what is an asset bubble? So an asset bubble is a scenario where asset prices increase significantly, typically in a short period of time, to the point where they're no longer supported by the underlying fundamentals. And during these periods, it's as if, every bit of news that we receive validates or verifies the story. So regardless if the news is good, bad, indifferent, the asset prices continue to rise. And two, the most recent examples that we have of this situation go back, to the early 2000s with the dot-com bubble. So you had all these stocks running up, just crazy levels. The catchphrase was, the internet is going to change everything. So a lot of investors took that as if, every company associated with the internet was going to quickly turn a profit. There was a ton of money to be made. And we all know how that played out. Most of those companies ended up being bankrupt. Stock prices went to zero. And the NASDAQ lost right at 80% of its value very quickly when that bubble burst. Fast forward 6 or 7 years to the housing bubble. So at that point, investors, home buyers, it felt as if real estate prices could not decline. Like that just wasn't a possibility. So no matter what price you paid for your home or commercial property or whatever, investors felt confident that they would, have an appreciation on that property, every year going forward, and there was no chance to lose. And we know how that played out. We overproduced, speculative houses by the thousand, and that bubble eventually burst, leading to the financial crisis. So today, markets are again, at or near all-time highs, and the question is being asked again. Are we currently in a bubble, particularly with the stock market? And although there are plenty of signs of speculative bubbles in the marketplace today, I tend to think that the overall broad market is not in a bubble at this point, and I'll give a few reasons why. We've heard a lot from the financial media this year that stock prices are rising for no good reason, and that it's not exactly true. All you have to do is look at the earnings growth on the S&P 500, for example, this year, up 26%. So pretty much in line with what the index has done year to date. So there's some pretty good fundamental support from this melt up in earnings growth on the S&P 500. For those that are concerned about the valuation of the index, which is about 21 times forward earnings currently, so significantly higher than historical levels. But if you dig a little deeper into that and you actually strip out the top 8 by market cap names from that index, the remaining companies are actually trading at 18 times earnings, which is much more in line with historical levels. If you take out those top 8, which are really your high multiple names like Apple, Amazon, Meta platforms, I still feel weird saying that, at Facebook, Nvidia, Tesla, Google, some of those high multiple names, the rest of the market and some really good companies don't look extremely expensive. Also, if we think about the cycle of investor emotions, we're not, I don't think, at a point of euphoria at this point in that cycle. So that's definitely a good thing for for markets going forward. Typically, when you get to the stage of euphoria, is about the time that you fall off the cliff. So that's you look at the chart, that's your point of maximum risk. And then despondency is John wrote an article I recall during the height of the pandemic, early 2020, and the market at that point, John was saying, was almost to the point of despondency, which is your point of maximum gain. That's where you want to be investing dollars at the bottom. So all that being said, it's not as if market risks aren't elevated at the moment. We're near all-time highs, so there are ample risks in the market that we have to be thinking about. I just don't think we're at the level right now of just crazy irrational investor behavior, which is a positive for markets. I also mentioned, we haven't had a meaningful pullback or correction. If you kind of leave out what we experienced early last year with the COVID sell-off, because the rebound from that was so quick, we haven't had a really prolonged correction in quite some time. So there's definitely some risk associated there. Just like the ebbs and flows of our economy, markets are cyclical too, and price corrections should be expected. That's a healthy and natural part of a market cycle, and they're inevitable. So what can we do about bubbles? The fact that asset price cycles, market cycles are so highly unpredictable, it just further strengthens the case for being invested in a well-diversified portfolio across various asset classes that don't all react in the same manner in a given situation. But having that level of patience and discipline to ride through the ups and downs, it requires knowing a few things about your financial picture. It requires knowing your time horizon for investing. It requires, knowing your true risk tolerance and how well you can sleep at night if we do get one of these big pullbacks in the market. It takes having a financial plan in place that tests all of these different market cycles, and we know at the end of the day that you're going to be okay. That's what we can do during these periods. So that's about all I have here. I think the rest of the conversation is going to be focused on what we can do during bubbles. So I'm going to turn it back over to John.
Yeah, and I think we'd just like to have a discussion. I mean, I think the goal here would be to kind of talk about a few aspects of it, and we've separated into three primary areas: investment management, financial planning, and then some commentary about behavior that we see in clients, that we see out in the world, with phone conversations we're having today with clients, and then also those phone conversations we had with them last March, sort of leaning on those. So let's just open it up to talk about investment management. How do we manage money? Let's just say that we believe at some point that we're in a bubble. How do we manage money during that?
I can start. I mean, I think the number one question we get all the time is, do you go to cash? Did you go to cash? Have we gone to cash? Will we go to cash? And I think pretty confidently our answer is no. We have very little intention to move to cash in nearly any market or economic environment. If you think back over the past 2 decades or 20 years, and we go to dot-com bubble, we go to the financial crisis, we go to recently with the COVID sell-off. In all cases, we did not go to cash, and we maybe raised cash a little bit for near-term liquidity needs, but generally moving in and out of the market, I think we all have a pretty firm understanding and belief that it's really difficult to navigate in and out of markets. And the challenge with that is you not only have to be right once, but you have to be right twice. You have to be right when you get out, and then you have to have the fortitude, and you have to have the conviction to get back into the markets when things are probably at one of the worst possible times. And we put up that chart earlier about the emotions of an investor, and typically when you're feeling that sense of I need to get to cash, I need to go to cash, things are as bad as they're going to get, and maybe they get even worse from here. That tends to be the point of maximum financial opportunity of when things are bad in the financial headlines and the media. That tends to be one of the best times to be an investor. So I think what's really important is the planning side of it, which we'll talk about tonight. But as long as we're making good decisions and we're always planning for some type of bubble occurring, and it's not as simple as saying if we're not in a bubble's coming, but generally we have to plan for market volatility and market swings. And so jumping in and out of cash is one thing that is probably the most common question we get, and one that we very firmly say if we planned it well, we shouldn't need to jump in and out of the market and playing around going all into cash.
Yeah, I mean that speaks so much to having a rules-based, emotionless process, which is what we try to stick to as much as possible. And we do that in many different ways, as Andy mentioned. Another way is through our regular rebalancing process. So it's making sure our client portfolios are in line with their intended allocations, so to ensure that we're not ever taking on unnecessary risks that our clients don't need to take in order to achieve their goals. And that's something we do regularly. We'll at least do that once or twice a year, and then at times we'll be strategic about it, just trying to add value along the way for our clients.
One thing that I know we use a lot with prospective clients, and then we also use with our own portfolios as we're managing throughout market cycles, is what we call portfolio X-ray. But basically portfolio X-ray, you can have a list of holdings, you can have a list of index funds, mutual funds, and you feel like you're diversified. But when you really break everything open and you look at actually the components of what you own, particularly in this environment where you have market cap weighted index funds, where you might have, what did we say the top 8 was?
30%.
30% of the S&P. you can create serious over concentrations and essentially be taking on risks that you don't really realize you're doing. So that's something, we spend a great deal of time just trying to figure out, as stocks, particularly as the largest stocks have just gotten larger, are we just creating too much overexposure to certain sectors?
Passively too.
Passively, yeah, without even realizing you're doing. I think a lot of investors don't realize the passive risk that they're taking on.
Yeah.
I think, just to jump in there, I think also, your allocation is so important when you're looking not only from stocks and bonds, but also just within your equity portfolio. I mean, talking about that 30%, I think people don't even realize they have an S&P 500 ETF and they say, well, I own 500 different companies. I'm very diversified. Well, the challenge with that 30% number is not only 30% in a handful of companies, but it's in 30% of a handful of companies, they're probably going to act very similar as well. So even if you're diversified within those 8 companies, well, hey, I own 8 stocks. But the way the trend is going from active management, passive management, even segments where you may own a lot of stocks in one segment, everything's being correlated so much that allocation nowadays, not only in the US, outside the US, small cap, large cap, mid cap, it's going to be so important to make sure you know what you own now more than ever, to understand what you own. Doing a portfolio x-ray is a great way to do that, where you can crack open those funds or ETFs to see truly what's your underlying allocation. Because I don't think, of all the times we've done that, I don't think anybody's ever seen or anticipated what it would actually look like. And
How many times have we had those conversations?
Right.
When we get the first statement and we come in, and maybe I'm a long-term investor, I'm like a blue chipper, and it's like, yeah, I have 30 stocks, but it's AT&T, G&E, Exxon, all blue chip dividend stocks. And so we're missing out on some of the opportunity we're talking about on the top end of the market, or vice versa. I know a lot of my peers love you called it, was it the Elite 8 now, or the Awesome 8? It's not FANG. We got 2 Fs, we got 3 As now, but those top end, you're really concentrated in one corner of the market.
And it's hard. It's not, I don't think it's to anyone's fault that's how their portfolios become. It's one of the hardest things we do nowadays, is trying to have an uncorrelated, diversified portfolio. It's, things with technology. Technology is great. It's been helpful for a lot of things, but it also has caused, when you can trade in the nanoseconds, it's really difficult to have things that act differently. So intentionality is so important.
And then when we go even look at the traditional sectors that we're talking about, those have started to blur.
Right.
So, what is a technology company? Is Apple a technology company when they're one of the companies that has the most cash of any, which is like a blue chip value feature? Is Disney, what are we, communication services? Do we need to be a technology company? Everyone is kind of blurring lines here. Is healthcare a technology company? So on the equity side, it's difficult. And then we get into the fixed income side, and I mean, there's even less investor attention there. And we've seen people come in with, one bond fund is the whole fixed income allocation. And, is that achieving the goals that we're trying to reach with our fixed income?
Right. I think that's one of the most overlooked parts of the portfolio all the time, but really a hugely important part is the fixed income piece. When you're talking about the goals of the fixed income, what is the goals of the fixed income? Really what we want to do, what our job is to identify the short-term, the near-term liquidity needs for a household. So 1 to 3 to 5 years out, and then have the fixed income in place to supplement those needs or to fulfill those cash needs, those liquidity needs, so that in the event that there is a bubble that had burst or just a normal market downturn, you don't have to sell the equities when they're low. That's what the fixed income is there to provide that piece for you, that security in your portfolio.
Yeah, no one likes fixed income when the markets are doing this, right?
Right.
They only like it when the markets are going down. So, it requires a little bit of coaching on our part to, convince and reconvince people that fixed income is necessary, but it serves so many purposes. I was reading some historic studies today, just talking about simple allocations between equity and fixed income, and just the amount of risk-adjusted return, just a little bit of fixed income can add to a portfolio. And most people, they look at a bond fund, they're like, it's only paying 1.5% or 2%. They don't realize there are other benefits from owning that.
Yeah, and it's also dry powder. So we kind of think of the fixed income and the cash somewhat in a similar bucket compared to the equity of this is money that could be safer money when we need income, but it could also be available for an equity shift if we feel like the time is right. So that's kind of a planning decision we can make. And if we think about having 2% of cash last year in the moment of despondency that doubles, that's really accretive to portfolio return,
Yeah.
having that flexibility inside of it.
I think what's interesting about the fixed income is I bet if you asked most investors why they own fixed income, a lot of people would have a hard time answering that.
Sure.
And the intentionality and rules-based investing of why we have an allocation the way that it is, it's such an intentional decision of adding fixed income. It's such a personal decision. Most people who have liquidity that may come from the portfolio should own some degree of fixed income, but there should be an intentionality behind why you own that, what it provides to you, going to your points, Frank, about liquidity and allowing you to maybe take risk in the other part of the portfolio. We've all heard the take 100 minus your age, and that's how much equity you should have. And the challenge today more than ever is just with interest rates as well, and how you own your fixed income. Your point of having one bond fund, well, you better hope that bond fund does well, or having a lot of 401ks nowadays, which still don't quite understand, but you have one or two in the allocation. You're soon to be a retiree. That's your liquidity. That's your near-term income if things don't go well. In the equity markets, it's so important to be rules-based, intentional, understand what you're doing, why you're doing it, and have optimization of everything you own. I think that's my favorite word to use. Is optimize what you own, what you're going to make, and optimize the decisions that you're making. And it's some simple decisions, some simple philosophies can really go really far away in investment management.
Yeah, I mean, I think it's safe to assume, I haven't seen any data to confirm this, but I think it's safe to assume that your typical retiree investor has less fixed income as a percentage than they would have 25 years ago, right?
Oh, no question.
Lower interest
Yeah.
rate environment, they
Yeah.
chase,
Mm-hmm.
dividend paying stocks or growth. And
Yeah.
I think in doing that are probably moving up the risk spectrum further than they would have
Absolutely.
otherwise wanted to do.
Not to mention a lot of your fixed income managers that you're hiring to manage this mutual fund, they've also drifted away from their mandate, right? So it used to be quite simple to get a 3 or 4% yield on their core mutual fund, and now maybe they're dipping down into lower credit quality stuff in order to chase higher yields, for their investors that they want to keep. So that's an area that there's a lot of risk in the fixed income market. It's important to really truly understand, how all of your fixed income investments, are going to react. Because you don't want them to react like your equities in a down market. I mean, that's safe money for a reason.
Let's pivot a little bit to talk about financial planning concepts that we implement, in the midst of bubbles or rising markets, falling markets.
Yeah.
We experience all of those things. So who wants to open up to talk about planning?
I'll go with the positive. I'll go with the up market.
There you
Somebody
go.
else take the down market. So we're in a positive market. Things are good, right? So what should we be? I love the rules-based investing. I think rules-based financial planning is mirroring to that comment. What do we need to be thinking through in a positive market? How can we continue to be diligent, continue to make good decisions? And I think the number one takeaway for financial planning is stay the course. In an up market and a down market, stay the course. For all of our clients, we have a plan set in place. We have an intentionality behind why we're doing all the things that we're doing. And, there may be things that in our minds we've already thought of and clients don't even realize that. Or if you're not a client, you're watching this, there should be a reason behind all the decisions you're making. It should be as unemotional as it can be. So what are some things in an up market we should be thinking about? The first thing that comes to my mind is stay the course. So if you're putting money into the market, if you are an accumulator in the accumulation phase, just because your portfolio has grown doesn't mean that you should stop investing. I think a lot of people think of a linear line in investing and they think, okay, I've gotten to this point, so I'm ahead of the curve. Well, we all know markets are cyclical. Things are going to go up, things are going to go down. So staying the course, when we do testing and we do our analysis, it's an analysis we have baked in good markets and down markets because we're going to experience those continually, going into the future. So just because the market's doing well doesn't mean you should change your contributions to meet your goals and meet your plans. Same things for retirees and people taking money out of the market. We really we think you should continue to, maybe we can dip in a little bit more, but when we do our testing, we optimize how much we're taking out. It is with the assumption we're going to have good times, we're going to have bad times. So I think where people can get a little ahead of themselves is, the market's up 2 years in a row, double-digit returns. We're well ahead of where we were 2 years ago, and all of a sudden people start thinking, well, I can take a lot more money out of the portfolio. The challenge with that is, while maybe yes, you can in a short-term calculation, in the down markets, we don't want people to have to withdraw less. Our goal for our planning is to not have to take a step back in down markets. So to do that, you got to stay diligent. I think just a couple quick hitters that we've been really working on with a lot of retirees is Social Security planning. Optimizing your Social Security is so important and can significantly reduce tail risk of a standard deviation of outcomes. So, in years where the market's good, we've really been pushing people just delay Social Security, take a little bit more out of the portfolio. It all goes in that calculation. It's not contrary to what I just said, but when you look at the global plan, it really helps reduce tail risk. I think, one thing that we say a lot that people just kind of take a step back or lean back when we say is take money out of your portfolio and pay off debt. Again, these things, not being contrary to what I just said, but making good financial planning decisions, paying off debt, accelerating expenses. If in 2 years from now you're going to have to buy a car and you're anticipating using financial assets to do that, go ahead and do it. Market's doing well. We have all those things built in. And then the thing that I just think is always important, whether you're in an up market, a down market, any given time, but especially now, is just liquidity. Build your liquidity. We always want to have, a year, 2 years worth of expenses that is really liquid, really low risk. So if you don't have liquidity, whether you work with us or not, but especially if you work with us, now's the time to have some liquidity. The benefit of making these good decisions now is when you're staring at the brink of a global shutdown, we have people who knew they had plenty of liquidity. We weren't having any clients really freaking out during that time period because we had already planned for that time period. So liquidity is similar to owning bonds, not fun, not sexy, but it really is a benefit when you need it.
That is so timely because I had 3 different conversations with people today about cash and thinking, do I have too much cash? And how much time have we spent coaching people about their cash holdings and saying it's fine to have that liquidity? What's making us want to go up the ladder of risk with these assets? If anything, it's helping you be a more disciplined investor on our equity side, letting us stay the course over there.
Right.
So, love it.
Yeah.
Well, you did up market. I'll take the easy job now. For down markets, I can just flip it and reverse it. So, I can think back to last year, different conversations we were having, basically the opposites. You talked about Social Security, timing income, had a conversation about that today. So your Social Security is a benefit that you have accrued that we know what the number is going to be. We had income throughout our life. We worked a certain amount of time. We know what it'll be now and in 5 years. So I like to leave the conversation open-ended. When are we going to take Social Security? Hopefully delayed if we're in an up market, but we always know if we're in a down market, we have a Social Security or a pension, we can time when to take it. Maybe it makes sense.
I think that's a good point, not to cut you off, but also it's a year-by-year decision, right? Yeah. You don't have to commit 62 or 70.
Yeah.
It's let's just see how things go, and we'll reevaluate in 12 months from now.
Right.
It's
and
not
Social Security even is monthly.
Right.
So we can pull the trigger at any time.
And you can look back 6 months and get a nice little paycheck.
So we can do a good job of optimizing. So, Social Security, I think that's a great one. I'm like the Mr. Roth, so I won't tell you all which domain name relating to Roth that I have saved for when I write my big book about Roth. But I'm a big fan of Roth. We've talked to our clients so much about the long-term benefits for you over a long period, especially if we're thinking about 2 generations, the power of Roth, and really just having multiple tax buckets even during your life that we can optimize when we're thinking about structuring an income over the next 30 years. Tax minimization today is not the goal. So, some CPAs might not want to hear me say that, but my goal is tax minimization over your lifetime. So let's minimize the amount of dollars that go to the government overall. So a great way to do that is we believe in Roth. Why not do it when we feel like we're in a relative trough? So, some of my most favorite conversations last year during the despondency is we pick up the phone and we say, okay, we were thinking, maybe we're doing 20,000 of Roth conversion every year for the next 5 years. Let's do 100 right now. We have a bucket of pre-tax IRA 401k assets that we know if we get those in a lower time in the market, we're taking proportionally more of them. Now we've got all that over in a Roth bucket working for us. That's great. And then you're just thinking about structuring income that you're allowed to have if you're a business owner. If we think the investment income is going to be down, that's a great time to take income on that side. Installment sales, things like that. Just anytime we can think about timing and pairing that up with the appropriate market, that's a win for our clients.
Absolutely.
I think, real quick, in down markets, in times of financial challenge, there's a lot of opportunity, right? So, and maybe even more opportunity. During the COVID crisis, there was a large orthodontist clinic that had, they were looking at their valuations, and, their income was significantly down. So during that time period, which I just thought was genius, they were also looking to sell their business. So instead of selling their or part of their business, they got a very low valuation, worked with an attorney, got a IRS approved valuation on their business, gifted part of that, and took advantage of the calendar year and the lower income that they had. They actually went back and even just shortly after that increased it a little bit, but it was still cents on the dollar that they were able to take advantage of. And through the sale and the gifting, in times of what most were doing or panicking, they were looking for opportunities to take advantage of things. So I think, again, when things are scary, that tends to be the most benefit of opportunity to take advantage of.
And when things are not scary, and when they're not at all-time highs necessarily, or at all-time lows, or whatever the case may be, I think one of the big things that a lot of people can do is to really build in the flexibility and financial flexibility into your life, cleaning up your own household balance sheet, getting rid of the debts that you can get rid of. To Andy's point, when markets are good, when they're up, that's a great time to take care of, to try to get rid of as many debts as you can. There's difference of the good debts like your mortgage or versus a bad debt like a credit card debt. The more of the debt payments, more mandatory payments out the door that you can eliminate in a good market, that just builds in the extra flexibility to your whole financial picture during every other market cycle, especially during the downtimes too.
Yeah, I'm going to lean on the fixed income topic a little bit too. A lot of our clients are taking income, and they're taking it from the portfolio. And we typically, in a given year, if we're taking income from that portfolio, we pay it out pro rata to the investments that they have or the income generated from the portfolio. But let's just say we're in a down market. Let's think about that. How would we handle someone who needed income? Well, we can lean on that fixed income. We can draw from that fixed income from any number of years. For many clients, that represents 5, 10, 15 years in some cases of income that they might need before we have to touch their equities, which, giving those stocks the opportunity to get out of that despondency period and get back to sort of a more healthy.
Well, we've had several down years in the market.
Yeah.
But how many times have we had down 5 years? Very seldom. How many 15-year down periods have we had in the history of the domestic equities? Zero. Yeah. I think there's a handful of months where we've had 10-year declines.
That's right.
So building that flexibility in, it makes us feel pretty good.
And I think daily we have the conversations with clients who are taking income of, should we cut it back? Things are going, which is the behavioral finance behind what we do is so interesting. But multiple clients, should we cut it back? Things got to come back down. Should we just be proactive? the planning we do, this should be able to withstand whatever we, aside from the absolute doomsday, which I did have one client call me in March and ask if this was the doomsday I was referring to. Thankfully, it was not.
No, absolutely. Yeah.
But I think going back to that staying the course, the plans you build, you're able to stay the course. Fixed income plays such an important role with that.
Yeah. Well, let's pivot and talk about behavioral finance. It's a big category. I mean, I think of it, as I mentioned at the beginning, in two ways. We've got the market and how it's behaving, which I think is really the chart Brian referenced. That cycle of investor emotions really, encapsulates what it is that behavioral finance is. But let's talk a little bit about our clients and sort of, how we sort of hope that they act and sort of how we discuss, that area of, because their behavior, I mean, we can coach them through everything we want them to do, but they have to agree, right? I mean, they need to be on board with it, and they need to be confident about it too. I mean, it can be very difficult in both environments, both the good and the tough.
Yeah.
Well, most of our clients, hopefully our long-term clients, have a great amount of trust in us, and we've had the opportunity to feel them out as an investor and see them kind of react to different times in the market. So, I think we do a good job of understanding their personal investor psyche and kind of making sure we're pairing them with something that they can deal with. But I was thinking about somebody that we brought on as a new relationship last January or February. And luckily, we did all the normal planning we do on the front end. We say, here's what you have, here's the goal, here's a good range of outcomes. We feel really confident about this. And also, we're going to test in a bear market test. So let's just say that, now or sometime in the next few years when we're thinking about retiring, let's have a 2008 scenario. And how does the portfolio react to that? And that was just, you could call it a throwaway conversation. It's just we're trying to build an understanding that we feel like this is a really sustainable path. Well, then we look back less than 60 days later, and we're kind of there. And I thought it was great, just a great maxim of mine is just let's put some numbers to it. Let's test the plan. Let's see what it looks like. So we go back and look, and it's like, well, actually, this is not quite as bad as the bad scenario we painted. And now we can look a leg down from here, and we might make a little modification, but we're not going to have two historic down markets right on top of each other. Then we're going to have a chance here. So I think testing the plan really helps behaviorally because we're getting to know each other. And that's kind of the nightmare scenario on the upside of right when we're starting, things start looking so good. So test the plan is what I come back to.
I think proactive is the word that I think really for almost everything kind of comes back to. But, testing the plan, you're being proactive, you're thinking through these scenarios. We have clients who all the time say, what are you going to do if the market sells off? And my response is, well, when the market sells off, we're going to do this. And we've proactively thought through all those decisions. I think, the thing that probably bothers all of us the most is when we could have made a proactive, better outcome, but we weren't involved. So, we always tell our clients, lean on us. And we truly mean that. We want to be involved with everything and anything, what as small as it may be or as big as it may be. We've dealt with, between all of us, we've probably dealt with most scenarios. And if we haven't, we want to learn about them. So the more proactive planning you can do, the better your outcome is going to be. There aren't a ton of surprise things that happen within our business at this point. And, we've been through them. I think the biggest benefit our clients have is they're going through things one time. We've gone through it hundreds of times. So, we know who to bring in certain circumstances. We know what challenges lie ahead, what, hidden steps there are that you may not realize. And then just having another voice of reason in the conversation, just as much proactive planning and as much as we can think through the future, your outcome magnifies significantly for the positive if you do all the things right and you optimize the decisions you're making.
So you're talking about proactivity on both sides, right? So our goal is to be proactive with our clients, but we're saying please be proactive with us, because I had a conversation today about a completely separate topic, and then it's like, oh yeah, can I do a health savings account? Well, we need to make sure you're in a health plan that allows you to do that, and we got to do that now if we want to do that next year. And I was just glad that we're included in that decision making.
Yeah.
Because had we not had that conversation, we wouldn't have been able to
think
create that opportunity.
and communication goes with that, right?
Yeah.
So we try to reach out to our clients. We try to meet with everyone at least once a year,
Mm-hmm.
plus or minus. Life happens. Sometimes we may meet with someone 10 times in a month, and then we don't see them for a couple of years. But the more we know, the better we can help advise, because we have a toolbox that's huge.
Mm-hmm.
And the more we can understand what's going on in someone's lives, their concerns, their opportunities, the things that excites them, the things that scares them, communication is so important, and allow us to use the tools we have by knowing more about our clients and having a relationship with them.
Yeah, I mean, so if we're being proactive, if we're building the plan, if we're testing the plan, we've established, what our safe assets are, the amount of liquidity we need. We've established the amount of, the percentage of the pool that we can be aggressive with. It's important to view those aggressive assets, those long-term assets, as exactly what they are, which is long-term. We buy these assets on a thesis that we've come up with, that we believe in, and it's important that we let that story play out and give these assets the appropriate time for that story to run its course. So it's another important factor when looking at safe money versus the money that we can be aggressive with.
Yeah, and I'll close it out on that topic, with just the message to control what you can control. We're talking about investment management and financial planning. You cannot control the stock market. We cannot control the stock market. There will be up periods, there will be down periods, but you do have a great deal of control on your financial plan. And so these decisions around debt reduction, around Roth conversion, all of those things are at your disposal. Those are tools that we have that, we advocate for our clients and hope they follow our recommendation. And, the other thing is, so many people sort of get caught up in getting overly ambitious when markets get really strong, overly pessimistic when markets get really conservative. It is a very stressful way to live your financial life that way. We like to, I think Cameron made the point, we like to find that balance. Your ability to sleep through the night is important to us, but we also want to make sure you're going to get there. So if we think you're being unreasonable with your level of aggressiveness or conservatism, we're going to tell you, because we're going to tell you where your plan needs to be. And hopefully we can get it to match close with where your investor psyche is at this point. So I'm going to hand it to you to kind of close us out.
Yeah, and I think I just, kind of to go full circle about what our topic was tonight, market bubbles. If we're proactively planning, if we have rules-based investing, if we're controlling what we can control, doesn't matter if we're in a bubble. I would say maybe it doesn't. And bubbles are going to come, bubbles are going to happen. We're going to have many ahead of us. And so, control what you can control. And I don't know that, it obviously we're paying close attention to it, but it's going to happen at some point, and it'll have multiple times, and the market's cyclical in nature. So I think our takeaway today is, communicate with us. Let us communicate with you. We like doing these educational topics because hopefully somebody watching this thinks of an idea of, oh, he mentioned an HSA. What's an HSA? So, just have an open dialogue with us. We welcome opportunity to have as many conversations with people as we can. We also want to thank Mayhem Multimedia. We're in this awesome studio. We really could not have done this without them. So thank you all for doing that. And if whoever's still watching, thank you all for watching this. If there's anything we can ever do to help you all, please don't hesitate to reach out to us.